We now turn to the topic of risk and return. Clearly, risk is an important thing in investing, either from the viewpoint of a business or the viewpoint of an investor. We need to be compensated for the risk we take. Well, how do we measure risk? What does risk mean? And as I say in here, if it's important, we got to measure it. That goes true for anything in business. If it's important, we need to measure it. I don't remember who did the quote, but I like it. And it says, what defines modern times is the mastery of risk, understanding of risk. Insurance companies, for example, but also throughout finance. What is risk? Well, mastery is probably a strong term. Nobody really predicted the pandemic. And if you've read the book, anything to do with black swans, you'll know that we have kind of a funky view and maybe a slanted view of what risk is. But let's talk about risk. So we've got to measure it. And in finance, the way we measure it is the standard deviation of future returns. Right? How widely could the returns be distributed? Now, people have tried other things to measure it. A lot of people, individual investors, they don't care about the upside or if it goes up a lot. What they care about is they don't want it to go down. And so behavioral economics will study that effect, that people are very risk averse, typically. They do not want to lose their money. So they're more worried about the downside than the upside. Most finance deals with risk as a standard deviation, which has both the upside and the downside. So here's the mathematical equation for a standard deviation, denoted by sigma. This is a little sigma. Here's a capital sigma. This means the sum. So it's the square root of the sum. You take the differences of the rate of return in any period, minus the average, square that, add them up, and multiply it by the probability of that particular return. So that gives you the standard deviation. Fortunately, in Excel, it's a whole lot easier. You just use the standard deviation.p. I don't want to go into that, but that means it's for a sample size, and you put the numbers in here. And in Excel, it's pretty easy. You just sweep out the line of numbers that you want to find the standard deviation for. So think about T-bills at 4% return. Probably a low standard deviation. Right? They have a low standard deviation. T-bills don't change a lot. You're not going to see T-bills at 10%. But stocks, just think of what's happened to Tesla or to Facebook or Amazon. I mean, those stocks go up and down all over the place. Right? Much higher standard deviation, higher risk. So let's take a look at different types of securities. Here's their nominal average annual returns. This is since probably 1929. It doesn't say on the chart, but I think that's probably where these numbers look like they came from. Large companies, on average, they return 11.7% a year. Notice T-bills are down here at 3.8%. What's the standard deviation of those returns? Well, we've had stock market crashes, right? We've had recessions. We just had one in 2008. By the way, this is the longest period we've gone without recession since 2009, since 1929, I believe. So the standard deviation is 20%. Small company stocks, called small caps, deviate 33%. So they have a higher risk, but notice they have a higher annual return too. And as the risk goes down, so does the returns. This looks like a little bit like an anomaly for bonds versus government bonds. Risk went up a little with government bonds relative to corporate bonds. Real returns. So now what we want to do is we want to take these annual returns and subtract out inflation. And here's what we get. Okay? Now, again, higher risk, higher return, higher real returns. Risk premium is the amount that gets paid in interest, or the return that we get over the risk-free rate of return. So if we take these returns and subtract 3.8%, here's our risk premium, the amount that we're getting paid to take risk. Okay, here's the amount we're getting paid to take risk. It's the amount over the risk-free rate of return. This is a kind of a fun way from an investor to look at it. Since 1925, the average annual return has been 9.6% for all stocks. The worst year, I think this is the early 30s, negative 43%. People were jumping off of buildings. And then in one 12-month period, it went down 67%. On average, it goes up 9%, and the best 12 months was 163%, roughly. What's really interesting to note, and this is really important, this best 12 months happened right after the worst 12 months. So people that kept selling and selling and selling missed out on this going up. An important lesson, don't try to time returns. You will miss. So bonds, their worst return since 25, negative 7.8, annually 5.5. So you notice it doesn't go down as much, if that's what you're worried about, but it doesn't go up as much either. Cash, almost zero, basically. And so not negative. By definition, cash doesn't go negative, but it also is not going to go up very much. If you remember, inflation on the prior chart was what, 3.1%. You almost don't keep up with inflation. You barely keep up with inflation with cash. Here's another way to look at it. Here's the range of return for stocks for the 100 years, the 20th century. So stocks have traded in this range in a year, down as much as 30, almost 40%, up as much as 50%, 50-some% in 1 year. Bonds don't vary as much. Cash varies less in 1 year. And as you hold it out 20 years, notice the deviations, the spreads get smaller and smaller. Interesting to note that out here, the worst year after 15 years or even 10 years, the worst year for stocks is not as bad as the worst year for bonds. Now, risk is got two components. Not all risk is the same. We'll talk about this in the next video.